If an extra $100 of income pushes you into the next tax bracket, is it possible for that $100 of income to cost you $1,000 in taxes or more? A lot of people think that this is possible. I hear people all the time ask about getting pushed into the next tax bracket, and I get asked a lot about how to avoid going into the next tax bracket. It's a pretty common question, and a lot of people don't understand how tax brackets work. It's not something that I think you should feel embarrassed about. We don't know anything in life until someone explains it to us. So let's do that. Also, your tax bracket is not the only factor in this. You have to think about the impact of income limitations on tax credits as well. So make sure you stick around and watch that part of the explanation at the end of this video. While you're here, please like this video, share it with others, and subscribe to the channel so that you're notified when new videos come out. Thanks for watching. So let's start with the way that many people think taxes work. A lot of people think that if you go into the next tax bracket, then all of your income is taxed at that amount. So what would that actually look like? We're going to do some math, but it's just adding, subtracting, and basic multiplying. So we're keeping it at a third grade level here, and I'll show you all of this visually so that we don't get lost in all the numbers. To make the math simple, we are going to use these made up tax brackets. You also get a standard deduction when it comes to taxes, but we're going to ignore that for the illustrative purposes of this video. Our made up tax brackets: $0 to $10,000 is 10%, $10,001 to $20,000 is 20%, $20,001 to $30,000 is 30% tax. So if taxes worked the way most people think, which they don't, and you had $19,900 of income, then you would be in the 20% tax bracket, and you would pay 20% times $19,900, which is $3,980. Then, if you received a bonus check for $200, you would now have $20,100. That pushes you into the 30% tax bracket, and many people think that you would now owe 30% times $20,100, which is $6,030. That's an increase in tax of $2,050. So $200 of income would cost you $2,050 of tax. Again, this is not how it works, but it's a pretty common misunderstanding of taxes and how a lot of people think it does. In this situation, absolutely, you should avoid that $200 bonus check at all costs. But thank goodness it doesn't actually work that way. So how does it work? Only the income that falls into each tax bracket is taxed at that amount. So let's take the same example. We started with an income of $19,900. The correct way to figure the tax on that is to tax it through each tax bracket. So $0 to $10,000 is taxed at 10%, that's $1,000. The next $9,900 is taxed at 20%, and that is $1,980. So our total tax is $2,980. Well, that's already better than our initial calculation. The reason is because in our first example, which was the incorrect way, we taxed everything at 20% tax, but using the correct method, the first $10,000 of our income was only taxed at 10%. So now let's assume that we get the same $200 bonus check. We are now pushed into the 30% tax bracket with income of $20,100. But we now know that we don't tax it all at 30%. We still work our way through the tax brackets. So the first $10,000 is still taxed at just 10%, and that is still $1,000. The next $10,000 is taxed at 20%, and that is $2,000. That's a total of $20,000, which leaves us with $100 that falls into the 30% tax bracket. So $100 times 30% is $30. So our total tax is $3,030, not $6,030. That sounds way better. The difference when doing this the right way is now $3,030 minus $2,980, which is $50. So your $200 bonus costs you $50 in taxes, and you get to walk away with $150. I'm guessing you want that bonus check now, right? Because even though you paid $50 in tax on $200, which is 25%, you still have $150 more now than you did before. Of the $200 bonus check, $100 was still in the 20% bracket. We had $19,900 plus $100 gets us to the max of $20,000 where the 20% bracket ends. So you paid $20 on that, and then $100 fell into the 30% bracket, so you paid $30 on that, and the $20 plus the $30 is the total $50 extra in tax that we paid. So when calculating taxes correctly, what is your average tax rate? 30% is your top tax rate, but what's your average? To get your average on $20,100 of income, we take the total tax that we correctly calculated of $3,030 and we divide it by our total income of $20,100, and our average tax rate is 15.1%. Remember, you have to fill up each income tax bracket, so all of your income is not taxed at your top tax bracket. Just the amount of income that pushes into that bracket is taxed at that amount. So while your tax rate will go up on the next dollar of income, and your overall average tax rate will increase as well, you will never be taxed more than you made, and you will still have more cash in your pocket at the end of the day than if you don't make the extra money. With all of that said, there is something else that we need to discuss in order to get the full picture. There are several factors that all come together to determine your tax liability. It's not just the tax brackets. There are tax credits like the retirement savers credit, the child tax credit, the earned income tax credit, the American Opportunity Tax Credit. All of these have income-based limits. If you're in the 30% tax bracket, $100 of extra income results in $30 more of income tax. But what if that extra income also reduces the amount of retirement savers credit that you qualify for? Let's say you lose $10 of retirement savers credit plus pay an extra $30 in tax. That's a total tax impact of $40. So while you're in the 30% tax bracket, the effective rate was 40%. Once again, you still walk away with more money at the end of the day. You were paid $100. It cost you $40, and you have $60 that you didn't have before. So you still win, but the tax impact can be higher than what you originally expected. This interplay of tax credits and income thresholds and everything else that comes together on your tax return is the reason why you need to reach out to a tax professional who can utilize a tax planning software to make sure that nothing is overlooked. I won't say 100% of the time, but I'll say 99.9% of the time, you'll want to take the extra income because you'll end up with more money in your pocket no matter what you pay in taxes. But it's still good to do some planning and to know ahead of time what impact that extra income will have on your tax situation. Make sure you check out these other videos related to taxes and personal finances. Thanks for watching.